Imagine waking up tomorrow morning and discovering that someone has deposited $20,000 into your bank account. No strings attached, no debt, no taxes, just $20,000, ready to use. Now imagine you only have two choices. You can leave every dollar safely in a savings account or invest it for the future. 10 years from now, which decision will leave you with more money? The answer is far more surprising than most people realize. At first, the choice seems obvious. A savings account feels safe. Your money's protected, easy to access, and doesn't rise or fall with the stock market. Investing, on the other hand, feels uncertain. Prices move every day. Markets crash. Headlines create fear. So, why do many financial experts continue to invest instead of leaving their money safely in the bank?
Most people choose saving, not because it makes the most money, but because it makes them feel safe. You always know exactly how much money you have. No market crashes, no daily price swings. Just stability. And that feeling is incredibly powerful.
A savings account has one simple job: keeping your money safe while paying a small amount of interest. In the United States, deposits at FDIC-insured banks are protected up to the applicable insurance limits if the bank fails. That protection is incredibly valuable. But safety always comes with a trade-off. Over long periods of time, your money may grow more slowly than inflation or diversified investments have historically grown. If your money is safe, does that automatically mean it's growing? Not necessarily. There's an invisible force working against every dollar you own. It doesn't make headlines every day. You can't see it happening. But year after year, it quietly reduces what your money can actually buy. That invisible force is called inflation. Doesn't mean your money disappears. It means your money gradually buys less. Think about groceries, rent, gasoline, or a cup of coffee. Over time, many prices increase. If your savings grow more slowly than prices, your purchasing power quietly declines, even if your account balance never goes down. Inflation doesn't mean your money disappears. It means your money gradually buys less. Think about groceries, rent, gasoline, or a cup of coffee. Over time, many prices increase. If your savings grow more slowly than prices, your purchasing power quietly declines, even if your account balance never goes down.
That's where investing enters the picture. Unlike saving, investing isn't designed simply to protect your money. Its purpose is to help your money grow over time by participating in the growth of businesses and the broader economy. That growth is never guaranteed. Markets rise and markets fall. But over long periods, many investors have accepted that risk in pursuit of higher potential returns.
Many people imagine investing as buying numbers on a screen. But that's not what you're actually buying. When you purchase a share of stock, you're buying a small ownership stake in a real business. That business has employees, customers, products, buildings, and profits. As the business grows over time, the value of your ownership may grow as well.
But buying shares in just one company can be risky. Even successful businesses can struggle. That's why many long-term investors choose index funds. Instead of owning one company, they own small pieces of hundreds of companies at once. This simple idea is called diversification. It doesn't eliminate risk, but it helps reduce the impact of any single company's problems.
One of the most widely followed stock market indexes in the United States is the S&P 500. It tracks approximately 500 of the country's largest publicly traded companies. Rather than trying to predict which single company will succeed next, many investors choose broad market index funds designed to follow indexes like the S&P 500. Historically, the index has delivered positive long-term returns over many decades, although past performance never guarantees future results. Investing has helped many people build wealth over long periods of time. But investing is never risk-free. Markets can fall sharply, sometimes for weeks, sometimes for months, and occasionally for years. Successful investors don't expect markets to move in a straight line. They understand that volatility has historically been part of long-term investing. Fast forward 10 years. If your savings account earned a modest average interest rate, your balance would likely have increased. A diversified investment portfolio, however, may have grown significantly more over the same period. But there is an important reminder. Investment returns are never guaranteed. Markets experience both gains and losses along the way. Here's where the story becomes truly interesting. Over longer periods, compound growth has historically become far more powerful. Instead of earning returns only on your original money, your previous gains may also begin generating returns. It's growth building upon growth. And over decades, that effect can become remarkable. After 30 years, the difference may no longer be measured in hundreds of dollars. It may be measured in tens or even hundreds of thousands of dollars, depending on market performance, interest rates, inflation, and your investment choices. That's why experienced investors often say, wealth isn't built overnight. It's built through consistency, patience, and time. Most people believe the biggest investing mistake is choosing the wrong stock, but history suggests something different. For many investors, the greatest losses don't come from bad companies. They come from emotional decisions, fear during market declines, and overconfidence during market booms. Successful investing isn't just about money. It's also about managing your emotions. Market declines are not unusual. Throughout history, financial markets have experienced recessions, crashes, wars, pandemics, and periods of uncertainty. Yet after many of these events, markets eventually recovered and continued growing over the long term. Every downturn has felt different, but one pattern has appeared repeatedly. Uncertainty is temporary, while long-term investing is measured in decades, not days. This is why many financial planners recommend building an emergency fund before investing significant amounts of money. Unexpected expenses happen. Medical bills, car repairs, job loss. Having cash set aside may reduce the chance of selling investments during a difficult market simply because you need money immediately. Savings and investing aren't enemies. They work best together. The goal isn't to predict tomorrow's market. It's to build a financial plan that can survive tomorrow. Save for emergencies. Invest for long-term growth. Stay diversified. Be patient. And remember, time in the market has historically mattered more than trying to perfect. By now, you've probably realized something important. This was never just a story about $20,000. It's a story about decisions. Every dollar you earn represents time, effort, and opportunity. The question isn't simply where your money goes. It's what you want your money to do for you in the future. Saving and investing are often presented as opposites. In reality, they solve different problems. Savings provides stability when life becomes unpredictable. Investing gives your money the opportunity to grow over the long term. The strongest financial plans don't choose one over the other. They use both together. Hollywood loves overnight success. Real wealth usually looks very different. It grows slowly, quietly, one good decision after another. Consistent saving, thoughtful investing,
patience during uncertainty. Over time, those ordinary habits can lead to extraordinary results.
You don't have to become an expert overnight. You don't need to predict the market. And you don't need to be perfect. Every long-term investor started with a first decision: learning, planning, taking one small step. Sometimes the decision you make today can shape opportunities you won't see until years from now. So, if you had $20,000 today, would you save it? Would you invest it? Or would you build a plan that uses both? Because in the end, wealth isn't created by a single lucky moment. It's built through informed decisions made consistently over time. And perhaps your next financial decision